Let's talk more about the markets. Joining us now is Paul Christopher, head of global investment strategy at Wells Fargo Investment Institute. It's good to see you. You think the high end of a trading range is 5,500, 4,900 to 5,500. So we're at the top of that basically. You expect either sideways or retest of the lows, new lows, or just a retest?
Probably a retest of the existing lows, but again, so much depends on those sectoral tariffs and the negotiations, right? Sectoral tariffs, pharmaceuticals, semiconductors, possibly additional base metals, and then the tariffs on China. Those need to be reduced.
And is everything that determines your outlook based on policy, tariff policy? What else?
Actually, no. We're seeing quite an interesting, positive, what I'll call economic impulse. Spending still looking decent on the part of, if you look at credit card usage, especially those high income, high wealth spenders. The market doesn't seem to be affecting them directly yet. They have some cash reserves, and the low income households have some savings, and a lot of gig work. We're seeing that also buttress that income for the low-income household. So, yeah, there is some positive impulse there. The problem will be if you layer on more tariffs on top of that, then you get a recession.
And you don't think growth concerns outweigh inflation concerns? You don't want the Fed to cut. You think that at this point, tariffs bring inflation, even though because there would be reciprocal or a tit for tat with tariffs? Because it's a one-shot deal. It's not like the second derivative of inflation, where it keeps going up, 4%.
We're concerned with I'm sorry, we're worried about the reciprocal tariffs, yes, and the universal tariffs of 10%. And you're right, a tariff is a tax. A tax is a one-time hit to price. But we're seeing firms already increasing prices, and some CapEx firms actually increasing prices on their backlog of orders. So you will, we think, see some increase in inflation here in the near term. That's going to probably keep the Fed on hold. We would love to see a rate cut, but we don't think the Fed is going to feel like it can do that until inflation starts to come down or the economy, that impulse that I was talking about, that positive impulse, starts to wane more noticeably.
All the things you're talking about, Paul, are kind of front and center. When do you say, you know what, the market has already built all of these negatives into it, and a lot of times it moves long before we know that we're out of the woods fundamentally. What would cause you to decide that we're in that environment?
Well, if we got down to that 4,900 level and the president blinked, or some of these other countries blink, we see some big reductions in tariffs, then we think that not only will you see the market move first, but you'll see some of those earnings reports follow. Right now, we're not seeing very good beat rates. In fact, they're near record lows, and operating margins are starting to adjust lower. We need to see some movement on the policy front before we could start to see the markets then respond, and then we'd see earnings respond after that.
Yeah, that was my question. I mean, the markets, it'll be obvious to everyone by the time they blink. Then the markets respond. Why don't you? Usually the markets move ahead of the positive news you're describing.
Usually they do because they can anticipate it. But in this case, they can't. And that's the whole idea of this policy approach, which is to keep the opposition, the person on the other side of the negotiating table, wondering what's going to happen next. And so it's up to the president really to decide, OK, we're going to dial this back, or we're going to start emphasizing some of those other positives like deregulation that we need to see.
But
that makes sense. The idea in the art of the deal is that you want to keep your opponents on their toes and not know what's coming. Right. That's exactly what the markets don't want to see.
Or the markets have already anticipated a blink,
right,
and we don't go back down to 4,900, and we go back to 6,000. And we'll know, and we're going to remember. Go ahead.
I was just going to say, Paul, there's a headline literally in the last hour, Japan's economy minister saying no change to our stance that we are demanding full removal of U.S. tariffs. Do you consider this just an out loud negotiation? Do you say they're speaking to the folks in Japan to say we're not doing this? I guess what I'm trying to understand is we keep hearing from either our allies or adversaries, depending on what you want to think of them as, but the adversary, if you will, on the other side of the negotiation saying we're not doing what America says we're doing. And I'm trying to understand who we're supposed to believe.
Mm-hmm. I think this is all part of the negotiation process, and it's being carried out in a very public way. So you make a bid, and then the other person matches your bid and ups the ante. So now the Japanese, a very close ally of ours, they're saying, no, we want you to blink first. And so we'll have to see what happens here. But that's why I think markets can try to anticipate this, but it's not going to work because that's how you end up with these 300-point moves on the S&P intraday, or 3% moves, intraday moves, because you suddenly get something that the market could not have anticipated. So this open style of negotiation at this very high level is something that markets just are not used to. So we should expect in that range, 4,900, 5,500, we think. 4,900 is probably pricing in all of the reciprocal tariffs. 5,500 right now looks like, hey, we're going to see some of those go off. We're going to be somewhere in that range.